Hello, everybody. Welcome. My name is Renee Calabro, and I lead Edelman's private equity practice. We are thrilled to convene today's discussion for you. We've put a lot of energy and resources into our PE thought leadership as we recognize the importance of this industry, its influence, and touch points with all aspects of culture. Right now, the industry is at an inflection point as regulators publicly assert their plans. As we have seen across financial services, regulatory change brings increased scrutiny. We believe the industry needs to stand up for itself now more than ever. And we have a great panel today who will discuss the state of PE reputation. Drew Maloney, CEO of the American Investment Council, Pam Hendrickson, Chair of the Investment Council and Vice Chair of Riverside, Jill Granoff, CEO of Eurazeo Brands, and Steve Mosley of Alaska Permanent. We also have a great moderator in Ashley Lewis, who joined our private equity team directly from Senate Banking 2 years ago. Edelman has been studying trust for 2 decades. Many of you saw our trust barometer just released last week. At the end of 2021, we conducted our first ever formal study of LP sentiment towards private equity reputation. The results we are going to discuss today reflect the views of 400 LPs in the US, UK, Canada, and Germany. We asked them for their thoughts on PE reputation and factors affecting it. Before we turn to the panel, I will briefly review the biggest findings with you. The full report is online, and you are welcome to follow up with me with any questions about the data. There will also be time for Q&A after the panel. You can submit your questions in the Q&A box anonymously or attributed, or you can raise your hand during that time. Okay, on to the results. First, a word about the respondents. The 400 LPs we surveyed across Canada, Germany, the UK, and the US were split across investment style. 28% of respondents invest in industry-specific strategies, 17% in venture, 18% in growth, 14% in corporate buyout, 18% in credit, and 3% in distressed. 67% were male and 32% were female, and the majority were between the ages of 35 and 44. 42% said that they were in leadership positions, while another 39% said that they were in portfolio manager roles. On to the top findings. Within financial services, the private equity industry is trusted. A majority trust the industry to do what is right, and only traditional asset managers and banks ranked higher within financial services. Leadership counts. More than 80% of LPs cite high-quality leadership as a top trust factor and say that transparency and reputational strength are top trust factors. We named this report Beyond Returns because 1 in 3 LPs said that they give equal or more weight to ESG factors than they do to GP's financial performance when making an investment decision. While we appreciate that this is not a majority, we think it signals what might come, particularly if and when aspects of this historically private industry become public. Investment interest in the industry remains healthy. 45% of LPs say that their organizations have recently boosted allocations to the asset class. The LPs we surveyed in Germany stood out as the only market where LPs have lowered their allocations. Finding 5 surprised all of us. 74% agree that tighter government oversight and regulation is needed, and half endorse Senator Warren's proposed bill, despite its possible negative impact on financial returns. However, LPs were split across borders on whether the bill would hurt or help PE performance. LPs based in Germany and Canada said that it would hurt PE performance more than help, while LPs based in the US and the UK said it would help performance. A surprising 53% of US LPs said that the bill would make the asset class more financially attractive. With that, I will turn it over to Ashley and the panel, and I'll be back for Q&A. Thank you.
Great. Thank you, Renee. I hope everyone can hear me. Good morning. good afternoon, depending on where you may be. My name is Ashley Lewis. I sit on the Financial Services and Policy and Public Affairs team here in Washington, D.C., along with Renee's team in New York. And now I will just briefly let the panelists introduce themselves, starting with Drew Maloney, President and CEO of the American Investment Council. Oh, Drew, you're on mute still.
There we go. Thank you. Thank you, Ashley. Glad to be here today. Thanks for holding this panel. I think it's very interesting topic that we can discuss. As many of you all may know, the American Investment Council is the largest advocacy and research group for private equity and private credit here in Washington, D.C. We essentially protect the model of private equity. One of the most important things we do is storytelling. We talk about how private equity is the top performing asset class for pension funds. We employ more than 11 million workers, and we invested more than $1 trillion last year in the economy. 80% went to small businesses, 1/3 of that to businesses with less than 10 people. And today we just, we really try to make private equity relatable to policymakers. So today we launched a little video that shows Pam and I walking through Union Station, which is our Amtrak hub here in Washington, and a little more than 1/3 of the stores inside of Union Station are backed at some point by private equity. So it just, a lot of congressional Senate staffers and other folks frequent Union Station. So it's a good reminder, since there's no sign that says it's backed by private equity on the front of Walgreens or Dunkin' Donuts. At least it's a good reminder that we're in everybody's community. So thanks for having me today.
And next we will have Pam Hendrickson, Vice Chair of AIC and Vice Chair, I believe, of Riverton Company. So thank you, Pam.
Hi, great to be here, and thanks again. Drew already talked about the AIC, where I chair the board. In my day job, I work for a private equity firm called Riverside. We have spent over 30 years investing only in the small end of the middle market. So today we have investments across multiple capital parts of the capital structure in about 100 companies. So we have lots of stories to tell, and I enjoy telling them. And I currently am the vice chairman of that firm.
Wonderful, thank you. Next we will have Jill Granoff, CEO of Eurazeo Brands. Hi, Jill.
Hi, Ashley. So I am also the managing partner of Eurazeo, which is a global investment firm with 30 billion in assets under management, as well as the CEO of its brands division, where we focus on high growth consumer and retail brands. I joined the private equity industry about 5 years ago after a 25-year career building brands in the beauty and fashion industry. And my goal is really to work alongside founders and management teams to help drive growth by fostering innovation, digital acceleration, ESG implementation, all of which should drive value creation. We view ourselves as value-added capital. And I think this points to the change that we're seeing within the private equity industry, where it's not just about investing capital, but really operating support to help drive results. So I think I bring a different perspective to the table, but Eurazeo has always been on the forefront, be it ESG or bringing operating talent into the industry to really drive value creation for the various businesses in which we invest.
Great, thank you, Jill. And then finally, last but not least, Steve Mosley, Deputy CIO and Head of Alternative Investments for Alaska Permanent Fund Corporation. I know it's super early for you, Steve, so thank you for being here.
Thanks, Ashley. I'm actually in New York today. It's spent a lot of time here, so this is a more civilized hour than you'd think. But thanks for the intro. Thanks for organizing this. I'm Steve Mosley. The Alaska Permanent Fund's an $85 billion endowment that funds the state government and other activities in the state of Alaska. About 45% of the fund is targeted at alternatives, and about half of that is targeted at private equity. So it matters a lot to us, as it matters a lot to you. I'm glad we could do this.
Great, and thank you all for the wonderful introduction. So, let's just get right into it. So, as Renee went over the survey, one of the big 6 takeaways, one of them was the first one, which was 74% of LPs say they generally trust large cap and middle market buyout firms to do the right thing. And within the financial services sector, only traditional asset managers and corporate banks ranked higher. Pam, I'll start with you. What are your initial thoughts on the level of trust in the private equity industry as a whole? And based on your views, is now the time, for a reputational reset for the industry?
So I think it's really great that we work so closely hand in hand with our LPs, as is evidenced by your survey. Just to give some specific examples, I do think that CoInvest is a really good example of this. We bought 11 companies last year and offered $300 million of CoInvest, and the fund is only $1 billion, so that's a lot. Now, a cynic might say, well, LPs just did that to lower their fees. However, if they didn't actually trust you to work with you, they wouldn't do that. And in a specific situation, I actually talked to an LP about co-investing with us in a deal where he knew the deal, but he wasn't invested in that particular fund. And he said, you know what, I really trust you guys to do this. And another firm was involved as well. And he said, what are the growth plans? He asked me a lot of questions about that. And then he said, yes, I would like the co-invest. And not only will I take co-invest, I'll pay you for it. So I think that's a really good example of where the trust comes into play. I mean, it's survival of the fittest, right? So you don't raise your next fund if you don't, if your LPs don't trust you.
Drew, what about you? Or when finding the survey findings, what are your initial thoughts?
Well, I think one of the big ones was I felt like there was a little bit of an inconsistency in the fact that LPs trust the GP, but then they embraced Senator Warren's bill, and because that's sort of a distrust element. So, I think a couple observations on that. I would say, first of all, it's a little bit of a red herring because I think Senator Warren's bill generally doesn't enjoy that much broad support, even among her own party. However, so I don't think it's a legislative threat, but there are parts of it that you could see trying to break off from a regulatory standpoint, and the SEC, the FTC, and others try to move. But what I think is it really highlights is there's an opportunity for the GPs and AIC to work more closely with the LPs on policy. In short, it's a voluntary relationship between the GP and the LP. And our goal is to generate the highest returns for the beneficiaries of these pensions. So there should be very little daylight between the two of us on advancing those goals. And I think that most CIOs would probably agree that they would like the flexibility to work with the GP. And what they don't want is the federal government getting in the middle and federalizing the relationship between the two and setting the terms and banning side letters and doing a lot of that type of activity. So if there's an opportunity for us as GPs to better communicate and be more transparent with our LPs, I think we're open for that. If we're not providing something that they want, I think, tell us. And I think that that's what we want. But I think the last thing any of us need is the federal government coming in between the two of us, because that ends up in higher cost and lower returns. And I don't think that's a benefit for anybody.
Well, Steve and Jill, sitting on the other side of this, what are your initial thoughts on the survey? Steve, you can go first. Yeah.
I saw Jill reaching for the mute button, so Drew, I share your surprise. I'm unsurprised and pleased to see that there's generally a high level of trust, but I don't think that should surprise any of us. It's as LPs, we're committing blind pool capital for decades. That requires a very high degree of trust. And I'd reinforce your observation, Pam, about co-investments in that context. I think it's a measure of, it contributes to knowledge and deepens a relationship. And generally, the deeper the relationship, the greater the knowledge, the greater the trust. I suppose you could uncover things about a partner in that context that would undermine trust, but that's never been my experience. So that all fits together well. But Drew makes a great point about the inconsistency of a high degree of trust and appetite for regulation. I'm just one LP. I'm sort of a token LP on this call, but I disagree with the majority there that's endorsing or that's hopeful about the prospects for legislation like Elizabeth Warren's bill, which I view as overtly hostile and troubling. Although I might sleep a little bit better tonight, Drew, based on your comment that you didn't think it was a real legislative threat.
Got it. Jill, any thoughts?
Yeah, so I mean, on the one hand, you can talk about, surprise. I'd rather talk about delight. And I was delighted to see that virtually 1 in 3 talk about the importance of ESG and DEI in making their investment decisions. That has been so important to us. Eurazeo is a French company. We've been a pioneer in ESG for 15 years. It's required in France that 40% of board members be female. McKinsey has done a ton of studies to show that both gender diversity and ethnic diversity lead to improved performance. So I was really pleased to see that LPs are recognizing the importance of addressing carbon footprint, climate change, DEI, and all of those areas in terms of where they're going to invest, not just about the investment returns, but really the longer term impact on the world around us. So that was something I was really, really happy to see.
Shifting gears a little bit, I think Drew, like I know we've worked inside and outside of administrations in Capitol Hill, so on and so forth, but particularly in DC, a new administration means new regulators. So as we start 2022 and looking at the regulatory body or the alphabet soup of the regulatory regime that, has oversight of financial services, have any regulators floated anything, new policy or regulatory wise that PE plans to fight or oppose, or maybe even support?
Right. No, that's a great question, and one we're very focused on here in Washington. Just tomorrow, the SEC and Chairman Gensler is going to unveil his changes to Form PF, and we don't know exactly what those changes are going to be. But for a private equity firm, we file that form annually. And I don't know, I'm sure a lot of those folks watching this program today file those forms, and they can be, upwards of 500 pages each. So I think there's a couple concerns on that. Is one, do you file it more than annual? And, are you going to have to do it quarterly? You're going to have to do it monthly? What does that look like? And then are they going to request even more information for the form? And I think every time we think that, like, oh my gosh, the federal government can come in and be more helpful. If you're a younger firm, or if you're a smaller firm, and it'll be interesting to get Pam's view on this. You don't have a back office that's filled with lots of attorneys and that can fill out 500-page forms and do it on a monthly basis. So I think we have to be very cognizant of what's the goal. What are we trying to, why do we need to gather this information? I mean, if you look over the past 20 years, the allocation from pension funds to private equity has tripled. And it's tripled under a regime that allows us two parties to negotiate, whatever agreements we need to on fee management, on types of investments. And I think that's really worked well. And it's worked well in an environment where fixed income isn't delivering the results that they need in a low interest environment. So we need more private equity and private credit. So I think we just have to be very careful when we go into the SEC and ask for more regulation, like what's the impact of that?
Right. And so, shifting gears, and, Edelman is the House of Trust. We do the Trust Barometer survey every year, and then, subset surveys here and there based on industry. But really, when looking at what influences reputation, because this particular survey was geared around reputation, We know that media often plays an outsized influential role, even if media is less trusted. What does the industry need to do to help tame some of the noise around its reputation? And how do PE firms' stories or image impact your investment decision? And I will start with Steve on this one.
No, thanks. I'll come back to the initial part of your question, which was about potential responses. But just observe that these reputational considerations are relevant on at least a couple of levels. I think a lot of what we're talking about here, if we're talking about Elizabeth Warren, or if we're talking about press coverage in the Times, or even public hearings at public pension funds in the US, it's the reputation of the industry overall that I think is most threatened. And as participants in this ecosystem, I view that as a threat to our returns. I view it as a threat to our beneficiaries, and it needs to be managed. That's the level at which you affect decisions that will be made by board members, trustees of LPs, by allocators generally that are making determinations about the degree to which they want more exposure to this asset class versus less. There's another, and so I think that's critical, that's essential, really, that's why we're all here probably. But additionally, reputation matters on a kind of a one-to-one level, or maybe an institution-to-institution level. And that's my experience day to day. I guess I do have, none of us are immune to stereotypes. We hear things, we hear rumors. I likely to know something about an individual or a firm before I actually meet with them. But I guess my view in that context is that reputation matters less because we're able to form independent judgments. You can form a view of somebody when you look at them in the eyes that you can't extract from the New York Times. So I'm less worried about reputation there. It can certainly get in the way of investments, and I have had the experience, probably others have too, of choosing, more often than not, choosing not to invest because of some perceived character issue. A very litigious GP, for example. I've met with litigious GPs that tell me they like to resolve things outside of court, but there's evidence that they are actually resolving some of their conflicts in court. I find that a little bit troubling. You might characterize those as reputational issues, but my point is just that most of these considerations, because they're high level and uninformed, matter on an industry level, and we should all care deeply about that. And in terms of addressing that, this is a longer and more important topic that, I think, Pam and Drew are already well advanced on this front, as evidenced by the video you alluded to, Pam. I think the only way to compete there is with data and messaging. Clearly, that's the what Elizabeth Warren and others are doing. They're putting data out there that I think need to be assessed, absorbed, and countered with other messages. And Drew, you'd have better instincts here than I do, but maybe since we're talking about the world we actually live in, it might be stories more than data, or stories backed by data that affect people's opinion and create continued momentum towards what we think is really a great form of ownership for private businesses.
Great. And Jill, you said on the business side as well, and then possibly Pam to answer the question. What are your initial thoughts on, how the image of PE and reputation and taming some of that noise, or, countering some of that noise that you see out there?
So look, what I would say is we have to be better at storytelling, as Drew pointed out. I think the media likes to focus on negativity, whether it's geopolitical events, crime, et cetera, et cetera. So I think we have to be better at the storytelling and pointing out all of the positive aspects of what private equity does, and also how it's changed. I mean, if you think about the job creation, when I look at our firm, a third of our investments are in healthcare and technology, and how that furthers the economy. So I just think that we all have to be very, very focused on a more balanced approach. I think part of the issue is historically private equity was affiliated with financial engineering. By the way, that's not a private equity issue. You see that in public markets. Look at what's going on today, activism pressure at Macy's to spin out their e-commerce unit, or what's going on at Kohl's to unlock real estate value. So this is not a private equity issue. I think the bottom line is not all private equity firms are created equal. And there are many private equity firms that are really focused on infusing capital in critical industries to accelerate growth, to create jobs. And obviously we're generating outsized returns, which is benefiting the pension fund investors, which is helping people's retirement account savings. So I think we just have to be better at pointing out specific examples of things that we're doing. Let me give you an example of one of Eurazio's companies, not one of my own. We have a company called Doctolib. They're an online booking service between patients and providers. I mean, during the global pandemic, we created a whole website that would let people know where vaccines were available. We helped them schedule appointments. I mean, these are things that we're doing. I have a company in my portfolio, maybe less serious, called Nest, where we basically created products and hand sanitization, products to help wellness, because so many people were under emotional stress and duress. So, from little to big, I think there are so many different examples of steps that private equity takes. But I think the biggest is we're investing money to create jobs, to drive growth, to generate returns, which helps, pension fund returns and other returns, et cetera. And I think we just have to get more of that message out there.
Great. Pam or Drew, any thoughts on that question?
I was just going to add that I learned an important thing from Drew, which is all politics is local. And so, we have 50 states and we have private equity investments in every single one of those states. So we need to have those companies. I mean, who wants to hear from people like me? They don't, but they do want to hear from the CEO of our companies, who, has been backed by private equity and whose company has grown as a consequence. And I think Steve wouldn't invest with us if we weren't driving growth.
I think Pam raises a good point. And, I think you've seen a big change in the industry just in the last 5 years, where a lot of companies have engaged in reputation management a lot better, and storytelling a lot better. And I think one of the things that's changed, and I think this goes back to your point, Ashley, it's, we're in a very noisy environment, and we know that conflict sells. So you have to develop the channels to deliver your data on your messaging that are outside of your traditional earned media, major mainstream media channels. And, we've done that here at the AIC, doing a lot of direct delivery through social media channels and that sort of thing, just to get the story out. But it really goes back to Pam's point, is you have to connect the policymakers with private equity in their backyard, so they better understand what we're doing and can appreciate the benefits that we provide in their communities.
Ashley, if I could just add something here from the LP perspective, you may have seen that ILPA has done some work here, and ILPA also, as you know, Drew and Pam, is out there talking to legislators and regulators and seeking to align ourselves to the extent we can with the AIC and free markets generally. The appetite and interest from, and I've done some of these short version of these Washington tours, the appetite and interest is a direct function of exposure to voters and economic interests in their constituencies. So if you're from Wisconsin, you care a whole lot about Wisconsin, and this is not a surprise to anybody who lives in Washington. But to me, I was surprised at how impactful local commentary was when we could talk to them about businesses that employed voters, not to sound too cynical about it, and generated revenue that had great impact. And so clearly the storytelling, the story building needs to consider that.
Great, thank you all. So shifting gears a little bit and looking at what we are now 2+ years into the COVID-19 pandemic. And we all know that businesses, both public and private, have had to really shift their approach on how they do business, how they look at business, how they interact, with consumers. And we're really starting to see investor preferences changing. And much of that has to do with, a tag word, buzzword, stakeholder capitalism. We see, in the Edelman survey that LPs want private equity firms to do more. So, Jill and then Steve, what role does private equity play in stakeholder capitalism?
Well, obviously, there are a lot of different stakeholders. The stakeholders could be the consumer. It could be the employees within one of our portfolio companies. It could be our investors. And I think it's important to take all of those needs into consideration. But without a doubt, during the pandemic, we were there to support our companies with cash needs. If all of a sudden, they found themselves cash constrained. So we wouldn't let companies go under. We supported them during challenging times. I think that's critically important. We did as much as possible to, preserve jobs, which we thought was key. And then we really focused on how do we sort of change adversity and create opportunity. So we shifted our focus, as I mentioned earlier, in terms of, products or services that we were offering to various consumers so that their needs were met. So, and at the end of the day, we feel that if we're doing a good job with our companies, then they'll deliver good results and then our LPs will benefit. So again, we take that sort of strategic and operational focus to drive financial returns to benefit the stakeholders. And what we had to do during the pandemic was be very nimble, really assess how we can optimize the performance of each of our companies and be there alongside them to help them, even if it was getting loans, et cetera, as people, weren't shopping or stores were closed or whatever it might be. So I think that we're helping with stakeholder capitalism by being, not only proactive, but reactive when the situation warrants it, and to be supportive partners to drive outsized returns over the long term.
Yeah, it may be that one of the undertold stories or a theme that deserves more attention in this context is that private equity is a form of ownership that has characteristics that are different from ownership in public companies. And if by nature we're longer term investors, I think there's an argument that we can, and here I'm referring to the entire ecosystem, to GPs and LPs and others, we can make the investment required to do the right thing for the long run. Changing out board members or investing in coal scrubbers or doing something that has maybe some near-term transitional cost is theoretically less appealing to a company that cares about their next quarter earnings more than they care about their ultimate valuation in 5 or 8 or 10 or 12 years. And similarly, I think that private markets to some degree address the principal agents issues that can undermine trust in public markets. I think overall it may be a superior form of ownership, and I think without question it addresses some of the shortfalls of the fast money, fast market dynamic that you hear about every day on CNBC.
Yeah.
Can I just pile on to something that Jill and Steve both said, which is one of the CEOs, and she was a new CEO, relatively new, and she said, you have no idea how great it was to have a private equity partner, because I'd never been through a global pandemic before. It is really lonely at the top if you're running one of these companies. So to Steve's point about short-termism, which I think private equity has overcome, I also think there's a partnership aspect to it that we don't talk about probably as much as we should.
Yeah, and Drew and Pam, have you seen your members call you and say, hey, we really want to engage on stakeholder capitalism, or is that something you're starting to see more and more of, or what does that look like for you guys on the membership side?
Well, I think we're seeing a lot more interest in ESG and, what's the metrics around and what needs to be collected. And I think that we're all trying to get our arms around what does that data look like? And I know that, ILPA's working on some things, and there's some other of our GPs working with the LP community to find out and really identify what types of data are meaningful to our investors. Because right now, everybody has a little bit different data collection and different needs and different wants. And, if we can figure out some sort of uniform metrics around that, I think it would be very helpful.
Yeah, just to make that real for everybody, I asked, we have hundreds of pages of answers to due diligence questionnaires from our investors, and we are a global firm. So the Modern Slavery Act is a big ESG due diligence question in Australia, but our European investors don't ask about it. So what is a poor little firm like ours to do?
And speaking of ESG standards, Jill, and again, you working on the business side and component of things, how do you see the private equity industry aligning their investment strategies and priorities to, really be in compliance of ESG standards or to be a part of the ESG conversation?
Yeah, look, I mean, in our case, we looked at the SDGs, we developed a program called O+, and we set ambitious goals. That's the first thing, right? You gotta walk the talk, not just talk the talk. So first it's with goal setting. We said we were going to have, we were going to be carbon neutral in our footprint by 2040. We talked about where we wanted to be with DEI. So I think what's really important is to, align on the goals, set them, communicate them. More importantly is to track them and to report on the results, which we do as well at every one of our executive committee meetings. We have an update on the progress that we've made against our initiatives. That's not only at our level, at the GP level, but also among our 500 portfolio companies, across the board. And by the way, we screen all of our companies before they can come into the Eurazeo portfolio. And then we have a certification program to help advance their progress, so like LEED certification going from bronze all the way up to platinum. And so we report on what progress we're making with all of our companies. But we've actually taken it a step further. And executive compensation is actually now tied to the ESG results. Okay, so what's important is you have to have ambition, you have to track performance, you have to report on performance, and then you have to pay people for the results they achieve. And once you tie the incentives to those results, wow, you'll see behaviors change. So that's what I think private equity firms need to do. They need to be really serious. It starts with goals, but it's also the roadmap to get there. Having a team of people to implement. We have a whole team of people just tied around ESG, DEI that could work with our portfolio companies to ensure that we deliver on the promise.
Right. Just for time's sake, gonna keep moving with the questions. We're all grappling with, what everyone is calling the Great Resignation. Labor Department said, the month of November, 4.5 million people voluntarily quit their jobs. So, Pam, when looking at portfolio companies, what investments are being made to really kind of balance, employee retention and satisfaction along with efficiency and innovation? Because I think that's often perceived as leading to job losses. What does that look like?
Right. And obviously I disagree a little bit with the premise around innovation, because I think that a lack of innovation and efficiency leads to lack of competitiveness, decline in revenue, and ultimately job losses. So I think one of the things that private equity is great at is helping a firm to figure out what are the efficiencies and what are the innovations that need to be funded. So we're great at that. But like everyone else, we're increasing wages. Average hourly wage, I think, is $20 an hour across our companies, and they're geographically dispersed. We are increasing the communications. So you see a lot more town halls, you see a lot more of that sort of thing. We're increasing engagement surveys. And we also have an executive in waiting program, which sort of mitigates the risk if someone does leave, then we can slot somebody in right away, which is extremely helpful, we have found. So I think, as one of our CEOs of the company said, it's really not hard to recruit or retain people if you're the best place to work. So that's where I think the focus has to be.
Right. Well, really looking at public companies like B of A or Amazon, and they've been making headlines of raising the minimum wage, and Pam, you kind of alluded or touched on this, but Drew, as the leader of AIC, is this something that, the PE industry supports, is raising the federal minimum wage, or is it you all are already doing that individually? How does that look?
Well, it's a great question. And, I think the pandemic has caused all of us to reflect on the workforce and what it means to be in the workforce. We've seen, wages increase. So I think, even talking about the federal minimum at $15 an hour, we probably passed that because of the inflationary time period that we're living in at this point. We're talking about worker flexibility, more power for workers across the country. Goldman Sachs just did their 10,000 person small business survey. The number one issue that small businesses across America have right now is the lack of labor. And it's across the board. It's not just entry level, it's mid management, it's across the board. And I'll just give you an example of a small ironworks company in rural Virginia. A year ago, they were paying $19 an hour for their entry level wage. Today, it's $25 an hour. On top of that, their steel costs have gone up 70 to 80%. So a job that originally was bid out at $100,000, today's it costs $180,000. And the challenge with that, I think, across the whole economy is that that cost gets borne by somebody. And at the end of the day, it gets borne by all of us consumers. So while I think we are seeing inflation in wages, we're seeing it across the board and everything else. And the question is it matched? And, I think we could spend hours talking about, what other things can we do as far as education in the workforce? How do we change our education system to meet the growing needs of what America's competitiveness requires today? It's a great conversation, and I think one that we could really have a lot more discussion on.
Yeah, Jill, because I know a lot of your portfolio companies are not necessarily in the United States, but do you see a difference between countries based on that, or wanting to raise a minimum wage, or are there set standards somewhere? What does that look like, and how does that impact your business?
I think we look at compensation more broadly than just minimum wage. We look at the benefits that we provide. I think one of the most important ones is healthcare coverage. Being a French company, we pay 100%, of people's medical benefits. And I think that, is something that is very attractive to people. So I think it's important to think about the full scope of support that we provide. Yes, minimum wage is important, especially at lower levels within our companies, but we also want to be sure that everyone has access to health care coverage. And that has been a focus area for us, which we know is really, really important throughout our portfolio companies.
Yeah, Steve, any thoughts on this one? Oh, you're still on. Yep, there you go.
I couldn't hear you, Ashley. Sorry, your voice.
I was just saying, did you have any thoughts or feedback on this question as far as like raising minimum wage, or does that impact your businesses? Or
Well, this will sound like a reflexive red state response, but I'm generally not a fan of minimum wages. We do have a system in Alaska, you may know, which is that we pay a dividend to every resident of the state, which provides the measurable social benefit. But I think I'm maybe steering us off track a little bit here.
Got it. Okay. One more question, then I will open it up to viewers. And again, one of the points, and Jill, you alluded to this earlier, one of the points in the Edelman LP survey was really on just, DEI initiatives, and where 1 in 5 considerations that limited partners said was more important than investment returns. And we all have seen studies really just how, like, the more diverse you are, the better, more profits, the bigger the company can grow, just as more inclusive as it can be. And so, how is the PE industry really making tangible efforts to ensure that people of color and women, have access, really to the upper reaches of this industry that, some may argue is still overwhelmingly white and male? And understanding too, like, not every group is a monolith. So like, what does that look like, and how, have you really, put the foot forward to increase and improve that? Oh,
Is
Jill,
that for
that's-
me or
yeah, that's
anybody?
for you, Jill. Yeah, that's you. Yep,
Oh,
that's
yeah,
for you.
look, I mean, as I said earlier, I think it's important that you have goals and you put action plans in place to achieve them. So, today, 30% of Eurazia's workforce is women on the investment teams. We've set a goal, we want to get that to 40%. How does that happen? It happens by ensuring that your slate of candidates, includes, women or people of different ethnic backgrounds. You're not going to achieve the goals if you don't start there. In addition to that, in terms of migrating up the ladder, we have education and training programs, et cetera. So, what we do is, as I said, we set the goals, we develop a roadmap to achieve them, and then we try to provide the support and capabilities. But at least as it relates to, having more women, gender diversity, ethnic diversity, it really starts with the slate of candidates. And if you don't ensure that when you're hiring that you have enough people, we're always going to hire the best person for the job, but you at least have to have a level playing field in terms of the people that you're, recruiting for. And I think some of the benefits that I alluded to earlier really help. Even on the female side, when it comes to maternity leave, et cetera, we don't want that to be a deterrent, but actually, we want to be, recognize that people have to balance work and family needs and everything else. Our company is led by a female CEO. I'm running an investment division. I'm a female. So I think, we set the example and then hopefully others will follow. But I mean, to me, we're a data-driven business, right? It's about people, but it's also about data. And I referred to the McKinsey study earlier, but there are results that show that when you have greater gender diversity, 25% outperformance, greater ethnic diversity, 36% outperformance. So if you believe in the results, then you have to take the actions to help facilitate that.
Drew and Pam, on the membership side, have you seen, CEOs coming to you guys saying like, hey, how do we really address this? Or should we create some standard or a benchmark of some sort?
So I'm not gonna answer that question. I'm just gonna pile on something Jill said, which is that I think it's the slate of candidates is really important. And I think it's about networks, right? So I have a probably different network than say Drew or Steve have. And Ashley, you probably have a different network than Jill or I have. And so I think making sure you're willing to take the risk on somebody who's not cookie cutter in the, I worked in an investment bank and now I'm going to go be a private equity person, that you're willing to take the risk on somebody who's just really smart and maybe has a different background. And I think that's really important. So now you can ask the other question to Drew. Sorry.
No. Well, thanks, Ashley. It's an important topic, and we've partnered with NAIC and Bob Green's group here in Washington, D.C. and many of our members have partnered with us on an internship program where we're bringing, women of color in college to intern at different private equity firms, including AIC. We have interns here that try to get them into the pipeline of being interested in private equity, because it's a problem that you have to fix much earlier in the process. And that's why we're looking at sort of that college level to engage. So we're very focused on it, and hopefully those efforts will continue to bear fruit.
We have a couple of interns also from that program, but we've also done, as have several other private equity firms, a partnership with this firm Suit Up, which really gets kids younger. We had a group of 8th graders who we worked with on one of our candy companies, a very suitable project for them. And they had to develop the marketing strategy, the funding strategy, and they had to invent a new product. So they spent 4 hours coached by various members of our team, and then they had to present. And we had the head of new products at the candy company come and judge. So that was a great way to expose everybody to a different option, to Drew's point.
Yeah, and exposure is key to, building that pipeline and network. So now that's my portion of the Q&A, but we have about 10 minutes or so left, and wanted to open the chat to any of the viewers who have questions. I see one question in here, and obviously I won't reveal names or anything like that, but the question is for Drew. PE is increasingly under fire for taking advantage of more lenient disclosure requirements to Two, for example, buy oil and gas assets from public firms that are divesting. I know you're against more government regulation. So what is the right strategy for PE disclosure to ensure firms and their portfolio companies are on the pathway to net zero and ultimately building trust within the private equity industry? A lot of words, but
No. I've seen this question before. This was generated by a New York Times story by one of these progressive groups called Stakeholders.org that, did a study on a little bit of the energy transition. So I have a couple observations on this. The first one, I don't think that our disclosure system is lenient. First of all, oil and gas is regulated by the EPA, the Interior Department, if you're on public lands, by state and local rules, as Steve well knows, in Alaska. So you're not getting away from any regulatory bodies, whether you're publicly held or privately held. That's one. Two, our investors, our LPs, whether it's Alaska, New York, California, pension funds, all know what we're investing in. So it's no secret to them if we're investing in renewable energy or investing in traditional fossil fuel development. And then I would say the third part of that is we're in an energy transition period. And while we invested, I think, $25 billion last year in renewable energy, which was half of all the private capital that was invested in renewable energy, there is still going to be, over the next 30 to 40 years, a growing need to produce enough fossil fuel, natural gas, and oil to keep the economy going. And you can't just stop it tomorrow. So there is going to be a transition period. So these assets are going to need to be operated by someone. And, I think that our LPs, we work together with them. We work with federal, state, and local regulators to operate these in the most safe and energy efficient way. So I do think that there's plenty of regulation around this to meet the needs of a growing world.
Are there any other questions from the audience at this point in time? You can either drop them in the box.
yeah, I just saw one.
There's an anonymous one for Pam.
Yeah.
Yep.
So Pam, our private equity firm is struggling with our development and mentorship program. What have you done at Riverside to allow employees to feel they are receiving the necessary tools to excel in their roles? We are hesitant to assign mentors/mentees because it feels unnatural.
Yeah, it's interesting because I think there's been a little bit of a conflation between sponsor and mentor. So to me, a sponsor is someone who proposes you for a new job. I mean, who basically is watching your career and helping you to develop. And I think sponsors are really critical. And realistically, in the private equity world, a lot of sponsors are white men because that is the level of people who run many of these firms. A mentor is someone who you can go and ask, like, what are you going to do if you're, what's the right time to tell people you're pregnant, for example? So I think it's really different. And we have been sort of cognizant of that at Riverside. I also think it's important to be flexible. In certain cases, the pandemic has really helped people because people who didn't think you could work from home have now realized you can. And so for a long time, I think diverse people have known that. And that has improved that situation a lot.
Jill, Steve, Drew, anyone want to take a bite at that question or just from experience? No? Okay, great. I think that was
maybe
it.
Jill maybe wants to.
Yeah,
Yeah, I mean, the only thing I would say is, we have a rising talent initiative. It's been in place for, I don't know, I think 2007. We've been working alongside the Women's Forum. We've tried to identify high potential females under the age of 40. We try to partner them with other female executives in terms of, sharing, key learnings, best practices to help them, evolve in their career trajectory. So, that's one of the things that we've done. We also have several philanthropic initiatives as well on the underprivileged side, to see if we can provide support and even provide entry-level opportunities into some of our portfolio companies. So those would be some of the steps that we've taken, to help develop women so that they're eligible to take on, these more senior roles.
Actually, somebody said this earlier. I think there is an education element here because, and obviously I'm only going to speak to men and women here because that's where I have the most experience, but they tend to hear differently. So I'll give you an example. I'm going to promote somebody and I have a male candidate and a female candidate. And the female candidate says, there's a lot of travel in this job and I have young children. And so it's going to be, I really have to think about it. And the man says, yes, I'm all in, I'm good. Well, hearing that, a woman thinks, okay, she's thinking about it, I'm not sure he is. And a man thinks, she's not confident, he is. So I think there's an element of education that is really critical here in terms of just translating.
Mm-hmm. Thank you so much. This is such valuable insight, and we're at time, and thank you to the attendees. We'll be following up with some content that's driven from this. And as I said at the beginning of the session, if you have any questions for the panelists or even for Edelman on the data that we pulled, we'd be very happy to follow up with you directly. So thanks, everybody, and hope to see you again soon.
Great. Thank you all.
Thank you, Renee. Thank you all. Thank you, guys.